Imagine waking up tomorrow with $10 billion. Congratulations! You can finally buy that private island you've always dreamed of, a luxury yacht, a private jet, or maybe even a solid gold toaster. Because apparently, that's something rich people could do. But there's one tiny problem. Not a single dollar of that fortune is sitting in your bank account. Every penny is tied up in company stock. Suddenly, you're incredibly wealthy, yet surprisingly short on cash. It sounds ridiculous, but that's exactly how many billionaires live. And here's the part that confuses almost everyone. When they need money, they usually don't sell their stock. They borrow money instead. Yes, people worth tens or even hundreds of billions of dollars willingly take out loans. Why would someone who could buy an entire neighborhood need to borrow money from a bank? The answer is far more interesting than you might think. Most people imagine billionaires swimming in piles of cash like Scrooge McDuck. Hollywood certainly doesn't help. Movies love showing giant vaults filled with gold bars and stacks of $100 bills. In reality, that's not how wealth works. When you hear that Elon Musk, Jeff Bezos, or Warren Buffett is worth hundreds of billions of dollars, it doesn't mean they have that money sitting in a checking account. Most of their wealth exists in the form of shares they own in their companies. Their net worth goes up and down every single day, depending on what the stock market decides to do. One good day on Wall Street can make them billions richer. One bad day can erase billions just as quickly, even though they haven't bought or sold a single thing. Think about it this way. Imagine you own a house worth $1 million. Technically, you're a millionaire. Sounds impressive, right? But now walk into your favorite coffee shop and tell the cashier, "I'd like a large latte, and I'd like to pay with half my living room." You'll probably get a confused look, and no coffee. Your house is valuable, but it isn't cash. Stocks work exactly the same way. A billionaire may own billions of dollars worth of stock, but that doesn't mean they have billions of dollars available to spend. If they want cash, they have to turn some of those shares into money. And that's where things start getting complicated. For most of us, selling stock is incredibly easy. Open an investment app, tap the sell button, and a few seconds later, the money appears in your account. But when you're the founder of one of the largest companies in the world, selling stock sends a message whether you like it or not. Imagine tomorrow's headline reading, "CEO sells $500 million worth of company stock." What's the first thing investors are going to think? Probably something like, "Wait, does he know something we don't?" Fear spreads incredibly fast in financial markets. Some investors panic. Others decide to sell before it's too late. Soon the stock price begins to fall, not because anything actually changed inside the company, but simply because people became nervous. It's a bit like putting your house up for sale, and suddenly your neighbors start whispering, "I heard that place is haunted." You haven't even sold it yet, but somehow its value has already dropped. Billionaires know that large stock sales can trigger exactly that kind of reaction. Ironically, trying to raise a few $100 million by selling shares could end up wiping out billions from the value of the rest of their holdings. That's not exactly a great trade. So, if selling stock can create problems, what do billionaires do instead? They do something surprisingly simple. They walk into a bank and say, "I'd like a loan." Not because they're broke, but because they own something the bank loves even more than cash. In the next part, you'll discover how billionaires use their stock as collateral, borrow hundreds of millions of dollars, avoid selling a single share, and why banks are often more than happy to say yes. Walking into a bank and asking for a $200 million loan sounds like something only happens in movies. If most of us tried that, the meeting would probably last about 30 seconds. The banker would smile politely, thank us for coming, and then show us the door. But for a billionaire, the conversation goes very differently. Instead of saying, "I have a great credit score," a billionaire says, "I own billions of dollars worth of stock." Suddenly, the bank is paying very close attention. Why? Because from the bank's perspective, those shares are valuable assets. They don't need the billionaire to sell the stock. They simply accept the shares as collateral, just like a bank accepts a house when someone takes out a mortgage. The billionaire keeps ownership of the stock, while the bank has protection if something goes wrong. Think of it like pawning a priceless painting, but without actually giving up the painting. You still own it. You still benefit if its value goes up. You're simply using it to unlock cash without having to sell it. It's one of the biggest financial advantages that wealthy investors have, and most people never realize it exists. Now, here's where things become even more interesting. Imagine your stock is worth $10 billion and you need $100 million in cash. Selling the stock sounds reasonable, right? Not necessarily. If you sell those shares, you may have to pay capital gains tax on the profit. Depending on where you live and how much your investment has grown, that tax bill could easily reach tens of millions of dollars. That's a painful price to pay just to access your own wealth. But what happens if you borrow the money instead? In many countries, including the United States, borrowed money is generally not considered taxable income. That's because a loan isn't new wealth. It's money you'll eventually have to repay. So instead of selling stock, paying taxes, and reducing your ownership, the billionaire borrows against the stock, gets the cash they need, and keeps every single share. Imagine there are two doors in front of you. Behind the first door is someone from the tax office holding a very large bill with your name on it. Behind the second door is a banker saying, "Here's the money you asked for, just pay us interest." Which door do you think most billionaires choose? And there's another reason they prefer borrowing. What if the stock keeps going up? Let's say those shares grow from $10 billion to $15 billion over the next few years. If they had sold part of the stock earlier, they would have missed out on billions of dollars in potential gains. By borrowing instead of selling, they keep their investment working for them while still having cash available to spend or invest elsewhere. It's almost like owning an apple tree that produces more apples every year. Most people would chop down the tree and sell the wood when they need money. Billionaires would rather borrow against the value of the tree, keep harvesting apples every season, and let the tree continue growing. Once you see it that way, borrowing doesn't sound so crazy anymore. In fact, it starts to sound surprisingly logical. Of course, this strategy isn't magic. It isn't free money. Billionaires still have to pay interest on their loans, and if the value of their stock falls dramatically, things can become much more complicated. In fact, that's exactly where the biggest risk begins, and it has caused serious problems for some very wealthy people. Of course, if borrowing against your stock is so brilliant, you might be wondering, why doesn't everyone do it? That's a fair question. After all, if billionaires can borrow money instead of selling their investments, why can't the rest of us simply buy a few stocks, take out a loan, and live happily ever after? Well, because that's a bit like seeing someone win a Formula One race and thinking, maybe I should drive to work at 200 miles per hour. The strategy isn't the problem. It's whether you have the right vehicle. The biggest difference is scale. Imagine you own $10 billion worth of stock and borrow $100 million against it. That loan is only about 1% of your total wealth. Even if the stock price drops a little, the bank isn't too worried. But now imagine someone who owns $100,000 in stock and borrows $90,000 against it. Suddenly, even a modest market decline becomes a serious problem. That's why banks are much more comfortable lending to billionaires than to the average investor. Ironically, the people who need loans the least often qualify for the best ones. There's another catch. Stock prices don't always go up. Markets have bad days, bad months, and sometimes even bad years. If the value of the stock used as collateral falls too much, the bank may ask for additional collateral or request that part of the loan be repaid. This is known as a margin call, and it's one phone call that nobody enjoys receiving. Imagine borrowing money using your house as collateral. Then, overnight, someone announces that a giant sinkhole has appeared under your neighborhood. The value of your home suddenly drops. The bank isn't calling because they dislike you. They're calling because the asset protecting their loan is no longer worth what it used to be. The same thing can happen with stocks. If their value falls far enough, the bank wants to reduce its risk. Even billionaires aren't immune to this. During major market crashes, some wealthy investors have been forced to sell assets or repay loans much sooner than they expected. That's why most billionaires don't borrow anywhere close to the maximum amount they could. they leave themselves a huge safety cushion. Think of it like driving across a bridge that can support 100 tons. Just because it can hold 100 tons doesn't mean you should drive a 100-ton truck across it every day. Smart investors leave plenty of room for unexpected surprises. This brings us to the biggest lesson of the entire story. Many people believe the rich use debt because they love debt. That's not true. They use debt because they understand the difference between productive debt and consumption debt. Productive debt helps you protect or grow valuable assets. Consumption debt usually pays for things that lose value over time. One builds wealth, the other slowly drains it. Think about it this way. Borrowing money to buy a business that earns more than the interest on the loan could be a smart financial decision. Borrowing money to buy the newest smartphone when last year's model works perfectly probably isn't. Both are loans. Both charge interest, but one has the potential to make you richer, while the other almost certainly makes you poorer. So the next time you read a headline saying a billionaire just borrowed another $500 million, don't assume they're running out of money. In many cases, they're doing the exact opposite. They're protecting the assets that made them wealthy in the first place. To them, cash is just a tool. Their real wealth is the collection of businesses, stocks, and investments that continue working long after the money has been spent. And maybe that's the biggest mindset shift of all. Most people spend their lives working for money. Many billionaires spend their lives building assets and then let those assets work for the money instead. So what's the real lesson here? It's not that you should walk away from this video and start borrowing as much money as possible. In fact, if that's your biggest takeaway, we've probably done something terribly wrong. The point isn't that debt is good. The point is that debt is simply a tool. Just like a hammer can build a house or break a window, debt can either help create wealth or create financial disaster. The difference isn't the tool itself, it's how you use it. The world's richest people don't borrow money because they're running out of cash. They borrow because they understand that selling a great asset isn't always the smartest move. If an asset continues to grow in value year after year, selling it today could mean giving up much bigger gains tomorrow. So instead of cashing out, they often use that asset to unlock the cash they need while allowing their investments to keep working in the background. In other words, they're trying to have their cake and let it keep baking at the same time. Of course, this doesn't mean everyone should copy what billionaires do. Most of us don't have billions of dollars in stocks sitting around, and banks probably aren't waiting by the phone hoping we'll ask for a $200 million loan. But that's okay, because the real value of this story isn't the size of their bank accounts. It's the way they think. While many people focus on earning more money, billionaires often focus on making the assets they already own work harder for them. That's why the biggest lesson from today's video has nothing to do with becoming a billionaire overnight. It's about understanding the difference between spending assets and using assets. Once you start seeing money that way, you'll realize that wealth isn't just about how much you earn. It's also about how well your assets continue working, even while you're asleep. If you enjoyed this video, please hit the like button. It really helps the channel and lets YouTube know you'd like to see more videos that make money and economics simple to understand. And if you enjoy learning the hidden stories behind finance, investing, banks, and the global economy, be sure to subscribe to Money Decoded. In our next video, we'll answer another fascinating question. Why are banks so eager to lend you money? Is it really just about earning interest? Or is there a much bigger secret behind the entire banking system? The answer might completely change the way you think about banks forever. Thanks for watching, and we'll see you in the next episode of Money Decoded.